Okay, so now let's take what we've learned about product costs and our period costs and look at how our statements change. Because our statements are different. They're a little bit longer, a little more detailed. Because again, if you remember from college accounting, how easy was your income statement? What did you put on your income statement in college accounting? What two types of accounts? That's balance sheet. You're close. It's kind of the same idea though. Cash was balance sheet. Expenses, good. Revenues, yeah. I know, right? Making y'all think. So remember, all the way back when we were doing service, if we were mowing lawns, we took all the money we made mowing lawns, our revenue, and we took out all of our expenses, tied to that, gas, equipment, salary, all of that, and subtracted it out. Revenues minus expenses. It was that simple, right? You had revenue, listed your revenues, added them up, expenses, totaled them up, subtracted. You were done. It was beautiful, right? They don't know how easy it was in college accounting right now. And then when we went into merchandising, we had to go a little further, right? Hopefully, right? You had to say, yeah. No. Yes, we have no idea how much further, but we went further. Well, it's kind of like, it starts here, at least on your notes, so you kind of can remember. Because we broke down our income statement a little differently. Remember, because instead of just saying total revenue minus expenses, we calculated a gross profit first, okay? Sales minus cost of goods sold equals gross profit. Y'all remember that? Yes. Yes, yeah, yes. So sales minus cost of goods sold equals gross profit. That's still the same, okay? We're just breaking down costs a little differently. In merchandising, we just figured out how much our cost of goods sold was, which was the cost of the product that we sold, right? It was pretty easy. So now, we're looking at going from sales minus cost of goods sold equals gross profit, and then we took out our period expenses, same as we will here. Now we're just looking at cost of goods sold just a little bit different, because instead of having one inventory account, how many inventory accounts do we have right now? 3. Very good. We have raw materials, work in process, and finished goods. So in order to calculate our cost of goods sold, we have to do some calculations, okay? And I actually give you kind of how to calculate that here on your notes, not as a T account, but just as a formula. When we're looking at cost of goods sold and we don't have that calculated, we're going to calculate it from our finished goods inventory account. So we're going to look at what we started with in finished goods, add in what was transferred in or what was finished in the period, and subtract out what's still left. And that will tell us how much we actually sold, okay, or the cost of goods sold. So again, we're only looking at costs here at this, from a lot of it, what we're calculating. We're still going to calculate gross profit and then our total income or net income. But yeah, your basic formula is the same. Sales minus cost of goods sold equals gross profit. We just have a different formula now for calculating cost of goods sold because we have to actually calculate. In order to calculate finished goods, we have to know what was transferred out of work in process. In order to calculate work in process, we have to know our materials, labor, and overhead. So that's when this nice little manufacturing cost flows comes in handy that I gave you. And I threw this out on Canvas as well. Okay, so we have to calculate all of these to get to the end, to the cost of goods sold. So we have to know how many materials we purchased, work in process. As you can see, I think it's a good time to talk about these. So these are all inventory accounts except for cost of goods sold. Cost of goods sold is an expense account. But your materials, work in process, and finished goods are all inventory accounts. So if you remember, inventories, again, are what are they? Assets, liabilities, or equity? Assets, very good. And more specifically, they're current assets. So all of these accounts are current assets. So as you can see, because I'm nice, I even put that they increase on the debit side for you. Because I know we forget, right, when we don't use them very often. So you have all of that here in front of you. So when we are looking at materials, we have some beginning balance in materials. We make purchases throughout the period. So that gets debited, right? When we purchase a good, materials are assets, so we debit it when we purchase it. And then at some point, we're going to take materials and transfer them to the manufacturing process. So, you know, the guitar, the wood, we transfer it to the cutting department or whatnot. When we do that, that cost gets transferred to work in process. Your work in process account, which is here, again, another inventory account, is going to be all the costs associated with production. Okay, so you have materials, raw materials go in, which I show that here. It's number 2, DN, direct materials. Okay, so direct materials come into work in process. Number 3, direct labor comes into work in process. Okay, and then number 4, factory overhead comes into work in process. So work in process has all of your 3 product costs for that period. So those all flow in. We'll probably have something still in there. That's the only thing with manufacturing. That's why it gets hard to calculate, because we don't just put into work in process. Yeah, it'd be great if like January 31st, everything we put into work in process was finished, right? That'd be wonderful, ideal world. But we know we don't live in that world where the last day of the month or the quarter, that everything that's in work in process gets finished and transferred out. So each of these accounts will have beginning balances. That's why it's hard to track costs, because we have beginning balances, all the costs coming in, and then whatever was finished in that period gets transferred to finished goods, which makes sense. Finished goods has a beginning balance. You add in what was finished in the period. And then if it was sold, it gets transferred out of finished goods and debited to cost of goods sold. Okay, so you can kind of see, in order to calculate cost of goods sold, you really have to know, if you don't know finished goods, then you have to calculate work in process, you know, so it's all a big flow. So hopefully this will help you as we go through. I use a lot of T accounts when we're doing examples in class, and I encourage you to do them on the homework and exam too, because if you can visualize what's happening, you're going to have a much better chance of balancing these accounts. Because sometimes it just may be like, well, what's your materials balance? Well, if you write it out in a T account, you can easily see it and balance it. To balance an account, what do I do? In any account, if I have debits and credits in an account, what do I do to figure out what the balance is? Come on, guys, you know this. If you have cash account and you have a long list of debits and a long list of credits, how do I know what my ending balance is? Subtract. Yeah. You add up all your debits, you add up all your credits, and you subtract, right? That's all we're talking about. So that's the same thing we're doing here. Sometimes, though, you may have beginning balance purchases and ending balances, and you have to calculate what was used. So you just have to do a little bit of a different calculation. But if you see it in front of you, it'll help make sense, okay? So use this, treasure it. Kayla, you'll get it again in cost accounting. Lucky you. So again, you know, our financial statements are just a little trickier. They're a little more in-depth and complex, okay? So again, we have to figure out what our costs are each period of what we actually sold. So again, all of those account balances are meaningful to us. We already talked about this. Again, I get ahead of myself. We have 3 inventory accounts. Okay, so we have to know the balance of each of these accounts to calculate cost of goods sold. Okay, so we went from 1 inventory to 3 inventory accounts. And so on our balance sheet, how that changes is this was just a snippet of total current assets for merchandising. You have cash, accounts receivable, 1 inventory account, and supplies. You know, we may have others, but those are the general ones. A balance sheet for a manufacturing company is going to have 3 different inventory accounts. The balance sheet's really not that difficult. Again, you just have to know what your balances are. So that goes back to that flow chart. Flow chart. Pronunciation is key, right? Oh, good times. So inventory on your manufacturing account is going to separate out direct materials, work in process, and finished goods. And then we're going to add up our total inventory. Those are the ending balances. So again, you have to sometimes calculate those. You have to know the T account balances at the end of the period. So that's where those are coming from. Everything else on your balance sheet is the same, okay? That's the big changes, okay? Now, of course, we may have more accounts with manufacturing, so we may have different expense accounts and things of that nature, different salaries. But the structure and the flow, this is the main difference on your balance sheet. Not bad, right? It's pretty easy. And this is what I have printed on your notes because I think it's where the main changes are. Really, when we were doing merchandising, this is showing the periodic method of merchandising. We didn't list like beginning inventory, net purchases, inventory available for sale. So really what we had was sales minus cost of goods sold equal gross profit. So if this looks foreign to you, that's why. They're showing a different method than what we used in class. So really, when we did merchandising, we just saw sales minus cost of goods sold equals gross profit. That's how simple it is. Manufacturing, as you can see, we have to know our cost of goods sold. So we still take sales. Sales is the same. It's our revenue. But now we balance, as you can see, our finished goods account. So we start with beginning finished goods. And we add in the cost of goods manufactured. That gives us our cost of finished goods available for sale. We subtract out the ending finished goods balance to get our cost of goods sold. And again, that formula is on your notes. Beginning balance plus cost transferred in minus the ending balance, and that tells us what was used and transferred out to cost of goods sold. So you can use those T accounts to calculate these, is what I'm getting at. The T accounts will go with your statements. And then we take sales minus cost of goods sold to get gross profit. Once we have gross profit, the only thing they're not showing you is we subtract out selling and administrative expense, maybe any income tax expense, things like that to get our net income. Okay. Any questions on that? Okay. Again, you know, they're just giving you some formulas. A lot of these I've already kind of given you, or we'll use T accounts to solve for. Okay. That's merchandising. That's what we did. Again, we didn't do that in merchandising, so let's skip over that. And we talked about this. So this is your cost of finished goods available for sale, and my thing is in the way. These are the two formulas that were on that statement. So again, we will use T accounts, and we will put that information into our statement. Okay. So what we do first, before we do our income statement, we do a statement called a statement of cost of goods manufactured. So not cost of goods sold, but just everything we actually made in the month. Because we know we could make a lot and sell very little, or sell it all. But we need to calculate that first. So the first thing we're going to learn how to do is prepare a statement of cost of goods manufactured. So what was actually made in the period? That will be equal to what's transferred to finished goods. Okay. So here is your statement of cost of goods manufactured. And again, you'll notice it's the exact same as what's on your notes. I just I cheated. And I didn't plagiarize though because I have educational rights to copy this. No. But as you can see, I put this on your notes for you. What'd you say?
You're honest with it.
Right? I mean, it's not, I have the academic right to copy for non-profit. I can't profit on it, right? So your statement of cost of goods manufactured. So don't sell your notes because then you're plagiarizing. Or my notes, but technically I own them, right? I should put a copyright on them. Oh, never mind. I was going to go off on a tangent, but we'll leave that one. So statement of goods manufactured. Again, it looks more difficult than it really is. As long as you're keeping your T accounts, what you're starting with on the statement of goods, cost of goods manufactured, if you look, we are work in process, beginning and ending. So what we're doing on your statement of goods, your cost of goods manufactured, is you're balancing this work in process account. So if we've done our T account, we're just taking what we already have in our T account and putting it in a report or schedule. Okay, so you can make a note of that. Statement of cost of goods manufactured, balancing work in process. Everything's going to come from there. You have your beginning balance, beginning work in process. Then we're going to calculate our cost of direct materials used. Well, this is actually balancing your materials account. So again, we're going to a T account. We take beginning materials, add in purchases. That gives us our cost of materials available for use. Subtract out the ending materials inventory. That gives us our cost of direct materials used. All of that's in your T account. You're calculating the credit, materials used in production. So that directly ties to this. Then we move to work in process. So we have materials used. We have beginning balance, materials used. We add in our labor. We add in our factory overhead. That gives us our total manufacturing costs incurred in the period. Okay. Then we take beginning work in process plus materials, labor, and overhead gives us our total manufacturing costs. Okay. Total manufacturing costs minus what's still in work in process because it's not finished, right? So we subtract it out, gives us our cost of goods manufactured. So we're really balancing our materials and then balancing our work in process to calculate what's transferred out. Okay, so it's really just about cost flows. Any questions on that? Looking at my okay. I think what we'll do today is just finish up the last little bit of this PowerPoint, and then when we come to class Tuesday, we'll do the rest of our examples because all the examples in this chapter are doing cost of goods manufactured and income statement, stuff like that. Okay, so it all kind of ties to this last portion. Chapter 15, it's like everything's just kind of lumped together, really. So normally we'll do more examples as we go through, but this one's kind of really understanding. What I want you to take away from today is just studying this and understanding the cost flows. Okay, so that's our statement of cost of goods manufactured. And this just shows us how this statement flows into our income statement. So to give you a heads up, this is our end goal for this chapter, is to prepare like an income statement. So I know it's hard to read, but we have sales minus cost of goods sold. Well, cost of goods sold is balancing that finished goods inventory, which was the last inventory account that we haven't balanced yet. But notice we have cost of goods manufactured on here. Well, again, that comes from this statement. Or if we didn't do the statement, we just need to balance our work in process account. Okay, and then we have sales minus cost of goods sold equals gross profit. We subtract out our operating expenses, which are selling and administrative, and we get a net income. Okay, so this is our end goal. It's not too bad, really. You just have to break it down step by step. Balance all of your accounts. If you put it all in T accounts, you have all your information. You just plug it into your statement. And that's how we'll do the exercises. That's why I don't want to get started on one, because I'll have all the accounts written, and if we don't finish it, then we'll be sad, right? Or I'll be sad. So that's kind of where we're going. They have the flow of manufacturing costs, just kind of showing you where things are reported. And then lastly, they show you kind of a comparative income statement, you know, from January to December. And then just kind of how all of that is determined. Again, so when we come to class on Tuesday, we'll kind of review really quickly so we remember where we were. And then we'll do a statement of cost of goods manufactured. We'll do income statement. Let's see, what else are we doing? Inventory balances. I think that's, yeah, that's the majority of it. Any questions for me? Okay. So over the weekend, you don't have any homework per se. You could get started on chapter 15, like especially the classifying costs and all of that. Again, just be reading over your notes and the flow chart. That way, when we come back, we'll be able to dive right into doing the statements. And have a great weekend.